And our fancy on-air sign is on. For everybody to notice. So this is what, September 9th. This is the pension task force. Chris is going to continue the discussion of underfunding.
Sure. Good morning, everyone. For the record, Chris Roop, Joint Fiscal Office. I hope you all had a much-deserved break over the Labor Day weekend. I did not prepare a whole lot for this section of the agenda today, but I did prepare one sort of visual that Gail has handed off over there. You know, I like to be a visual person, so I tried to take some of the drivers of unfunded liability data that was in that very big with small font chart that I distributed a couple of meetings ago and put it into sort of a waterfall chart like this. So this way you can sort of visualize the relative size of every fiscal year's experience contributing, deviations from assumptions contributing to the unfunded liability. So the first chart just walks you through the VSERS piece, and the second chart shows you the teacher piece. And I wanted to put some boxes in here just to illustrate sort of the relative impact of what happened before the amortization period began compared to what's happened since the amortization period began. So if you take a look at the teacher chart, the second chart, that box that I tried to shade in dark at the bottom left corner there, that shows you that $379.5 million, that's the unfunded liability that grew before fiscal year 2009. So that is what the system came into the current 30-year amortization period with an unfunded liability to address over that 30-year period. Any legacy underfunding of the VSERS system, which occurred pre-fiscal year 2007, shows up as part of that bar down at the bottom corner. Further actuarial analysis would be required to assess, all right, what is the ADAC we're paying today? How much of that is due to that? I did reach out to the treasurer's office after our last meeting. They said they have had some analysis on this issue done, but it needs to be updated because it's a couple of years old. And on the website, and if you haven't spent any time on there, the treasurer's office has a wealth of historic materials on there. Almost 20 years ago, some reports were done on the actuarial impact of underfunding back then. The actuary at the time, it was around 2003 or 2004, estimated that roughly $14 million of the ADAC back then was due to legacy underfunding up to that. Now, just as a reminder, we're paying, I think it's $196 million right now for the VSERS ADAC. So if you go back and take a look at all the things that have happened since then, 20 years ago was kind of a whole several generations back. We had different actuarial assumptions in place then, different interest rate assumptions. We had a different actuarial method in place, and it all happened before the current amortization period. So that's why $14 million is an interesting sort of relative guidepost, but that's a pretty old data point. The reason, just to go back to this, one of the studies you'll find on the website is they'll take a look at all of the ADACs from 1979 until the point at which the study was done. What was actually paid? One of the things just to be mindful of with the ADAC is, since it's a dynamic number that's recalculated every year, some portion of the prior year's underfunding is paid back in the subsequent ADACs. So when we take a look and say 170 some million dollars was the cumulative difference between what the ADAC was and what was actually paid, that doesn't necessarily factor in the fact that we paid a little bit more in every future ADAC to start paying back some of the prior ADAC. So some of that 174 has been paid back just as you go over time. So this is a very long-winded way of saying that it is a very complicated thing to tease out. It's way beyond my pay grade or what I can do, with a simple Excel model, and it does require some actuarial analysis. But when you're taking a look at the ADAC that we're paying now, the relative size of it, we're paying the share of that is due to paying what has happened pre-2009, which is just underfunding. It's, every system misses their assumptions just as you go. Experience doesn't always match equally with what you think is going to happen. But if you take a look back and see what the relative impacts were of different things every year, you know, a relatively small percentage of what we're paying today is due to underfunding and also due to just all the things that happened pre-2009, because those impacts were also spread over the full amortization period to pay back. You know, what's happening in FY20, that $378.8 million growth in the unfunded liability, right now we don't have 30 years to pay that back. We have roughly 16 to pay it back because there's that 2-year delay between when the studies are done and when it moves your ADAC numbers. And we have, you know, from FY22 to 38, it's roughly 16 years. So obviously the impact each year from what happened in FY20 is going to be much greater on the ADAC because there's just fewer years to divide that impact over. So I'm going to stop talking now and answer any questions you may have. But right now, the last I talked to Will and the treasurer's offices, they were going to take a look at what they'd already done and see what they can update. So I don't have that available today, but we did have that conversation.
So I'm going to say thank you for pausing.
Mhm.
And I'm also going to make one sort of technical announcement to the group and also pose a question or invite people to participate in a different way. But the technical first, I'm told by people who are watching us from outside that unless you are speaking directly into one of these microphones on the table, they can't hear you. And so I'm going to ask you to please keep an eye on your neighbor. If the microphone is in front of you and your neighbor is in line to speak, please hand it over and try to lean in so that people who are asking or people who are watching from outside can understand the question that was asked, because we can certainly hear Chris's answers pretty easily.
And the subtitles that appear on the bottom, really, I watched a meeting yesterday or the day before, and you would not have known what the subject of the meeting was because the subtitles are words as
Incomprehensible.
incomprehensible. I mean, the bathroom design from this group was one example, but I looked at that and there was no relationship to what they were actually saying to what was appearing on the bottom.
So if you're watching this, please don't rely on the on the subtitles.
Yeah.
Michael?
Thank you, Michael Clausen from the Treasurer's Office. I just want to follow up on Chris's last comment. We're hoping to have that analysis that he referenced sometime next week.
So what I want to invite folks to do right now is to, if you don't have a question, but you are feeling unsure of your understanding of what Chris is saying now and what we talked about in our previous discussion along these lines, please don't hesitate to say it in your words and ask Chris to confirm that that's, that you have the correct understanding, because these are complicated concepts and sometimes it just takes us saying it in our own words or repeating it in a different way in order to cement our own understanding. So anyway, that's
Molly Stoner. So I'll pick you up on that, Sarah, because what I was going to ask, in the same way that part of the unfunded liability has been, this is my understanding, I'm asking if I'm correct. In the same way that part of the unfunded liability has been paid in the past ADEC payments since 2009, I'm assuming that some of it is proportioned to the remaining 16 years in the schedule as well. Is that correct?
So I think I'm understanding your question correctly. I think I'm understanding it that, yeah, whenever they calculate the ADAC, they'll see, all right, what is the balance of the unfunded liability cumulatively as of this date? So whatever happened in FY9 through FY20, all those gains and losses result in a total. That total is then the payment calculation is that they'll take a look and say, okay, how many years is it between the present time and FY 2038? And how do we structure the payment so it has those 3% annual increases? But the balance and the number of years remaining between the balance at that point in time and FY 38 is going to determine what your ADAC payment will be in the future. So every ADAC payment we're making is in some way paying for all of the shortfalls that occurred in prior years, unless they're made up for through some other actuarial gain.
Which includes that unfunded liability piece.
Yeah, the ADEC,
It's one of. the
I'm only
many-
talking about the unfunded liability on the
I'm
ADEC, yeah.
sorry,
Yeah.
when I meant unfunded pieces of the visitor system.
Yes, so,
I understand that it's just
Yeah.
one part. I'm just saying that that is part of the next 16-year payment as well.
right, it's sort of baked into the base layer of the payment.
Yeah.
And unless we have, unless we're fortunate to have enough actuarial gain for other reasons, we have a great run in the market for many, many years, that results in lowering the ADEC for other ways. But yeah, every one of these years, you can kind of think of as adding another layer to the ADEC payment.
And in
as you go.
addition to the principal, what was not paid, there's the interest on that, like there is for every other factor too.
Right, the interest is calculated at the same rate as the assumed rate of return, and you're essentially making up for the lost assumed investment
Yep.
gains.
Okay, I think I have it right. Thank you.
Andrew Emmerich, just clarifying, because I was trying to in the paper, we're speaking about the VSTRS system currently, right
Correct,
now.
correct.
There was no underfunding of the VSERS previously.
Not to that level historically. The VSERS system at the end of FY07, I believe, or it may have been the end of FY08. One of those years, right before the Great Recession, the VSERS system was actually more than 100% funded. It had an $11 million positive balance. And I do just want to clarify that, the way the actuarial math works is it points you to 100%. That's sort of the star that drives all the math. You are not, unless you have a funding policy in place to the contrary, the actuarial math is not going to get you somewhere that has significant levels of overfunding. So it's not going to get you to be 130% funded, for example, because if you're overfunded, that gain is amortized over time, just like a loss would be amortized over time. So that actually reduces the amount you pay in otherwise. And if you take a look, I believe it's the FY08 valuation for the VSERS system, which covered that year, you can see in the amortization schedule what that looked like. So, we're used to seeing, you've got losses that you need to amortize. That means you need to pay more every year in the future. But if you had a gain to amortize, it's kind of the flip side. Like
Right.
you actually can recognize that the gain results in more savings over
Yeah.
time.
And so my second question would be, I'm still needing some help understanding the impact of the underfunding, how that impacts investments over that 28-year-ish period.
Yeah, I'm not sure it does, other than the fact that you have less money available in the portfolio to invest. So, but you make up for that the lost assumed investment opportunity through the ADEC payment, through the interest on the unfunded liability balance. So, there's certainly, we had years in the 80s and 90s with very, very strong double-digit investment returns that we really haven't seen consistently since.
Mhm.
So, there were certainly lost investment opportunities in previous decades. Had that underfunding not occurred, we would have seen bigger gains. But had that happened, we would have seen the ADEC payments in future years go down lower than what they were. So there's sort of this dynamic between how well you're doing in the market and what your future payments are going to be.
Because then the amount of money that was there would have been higher, so it would have decreased the amount of ADEC payments that needed to be made.
Correct. But we don't do our math on the assumption that we're going to get 20% gains in any given year. You do the math on the assumption right now that you're at 7%.
Right.
So,
Thank you.
Chris, one question on the historic VSERS funding. The funding, annual funding and the funded ratio at a point in time are two different things. It was 100% funded, but that relies on the assumptions, which if they're rosy, that can make up for past underfunding. I would like to see the VSERS funding history through the 80s and 90s, come back to the earliest actuarial valuation on the Treasurer's website. That only goes back so far. It's something I asked of the Treasurer's office when the Treasurer was in testifying. I think that would be helpful. And then I just also wanted to clarify, you're correct. It's difficult to sort of tease the different pieces out, and the ADEC certainly at the end of the schedule, it will have made up for that whole piece. but annually, it only makes up for a portion of
Correct.
the past funding, and there is this drag of not having the assets available. So there's an ongoing cost too. And at some point, the two paths cross, but do we know where that is? Or is
Yeah,
that some of the analysis? that's
You
presented?
make up for that drag through the interest payment
Right,
every year.
right.
You can, I'm not sure I understand the question of at what point they cross. If you take a look at the latest valuation from FY20, and you take a look at the amortization schedule for the future years, you'll see that, I think this gets at your question, the balance is projected to basically peak around FY22 or 23, if I'm doing that from memory, and then start going down. And that's because, the part of it is due to timing issues, and part of it is due to the fact, with our amortization method, which we talked about a little bit earlier, most of the principal payments are backloaded. So you have a level percent of pay system like we have, it's expected that your balance will get a little bit higher before dropping way down until your annual payments grow to the point where they fully offset the interest. So we've pretty much been treading water up to this point. The VSER system is slightly ahead. The teacher system is slightly below. Slightly, I mean, we're talking tens of millions of dollars in a, $2.9+ billion issue. But going forward, more and more of the payment is going to go toward the principal. And we'll have more revised numbers on that when they do the FY21 valuation as well.
So we did hear your request again.
Okay.
And we know that you did before. So Michael, can we get that from the treasurers?
Yeah, I just don't have data going back
No,
any further than what's on
I
the
know you don't
website.
have it. I just wanted to ask for that.
Right.
information. I wasn't necessarily asking you, I was just putting it out there.
But you made the request before.
I did,
So,
I did. Yeah,
okay.
thank you.
Okay, thank you.
And it's also worth just noting that the employer funds the systems in some pretty fundamentally different ways. So the VSER system is funded through a payroll surcharge that is assessed on the departments. So, internally a rate is developed and charged to the departments that employ the workforce. And then that money that's collected becomes the employer share. On the teacher side, that appropriation is made through a direct appropriation from either the ed fund for the normal cost or the general fund for the unfunded liability. And that direct appropriation is made out of the budget straight into the teacher pension system. So they're funded in some different ways.
Andrew Emmerich. So I know we talked about getting this to the actuaries, and I need some clarification, I guess, on where we fully left off on that. Is this something that has already been sent to the actuaries?
So we did not send this to the actuary. We started with making the request to the treasurer's office. So if the work was already done and can be updated in-house with minimal effort, that will save us thousands of dollars and time.
And do we have an update from the treasurer's office on that?
Mr. Clausen just provided it. We should have it in a week.
Can you use the mic and,
Yes, Michael Clausen, I'm sorry. Again, that's the same question we were discussing earlier,
I
correct?
thought so, yeah.
Yeah, so that's what we'll have next week.
Thank
And so the treasurer's office is working with the actuaries to update that information.
other questions or interpretations of what you think you heard, that you'd like to run by Chris in terms of the impact of past underfunding?
Well, we're ahead of ourselves.
We are.
Sorry.
Perfect.
Molly Stoner. Okay, so as I look at this chart, is each year in and of itself, or is it cumulative? Do you see what I'm saying? So if I want to know the impact totally, am I adding all those numbers?
Yes.
Okay, thank you.
On the teacher side, if you go way over to the FY20 box, the top of that where it says $378 million, that should line up to about 1.9 billion over on the vertical axis. So that's the cumulative total.
The cumulative is on the vertical axis.
Correct.
Okay, got Eric, you look poised.
Debating asking another question on this, but I had a request for the chairs too. So I'll go ahead and try to ask this question. Chris, I don't think I asked it well the first time. I wasn't necessarily speaking to the overall amortization schedule, but more thinking about like the drag that the underfunding at the onset creates. So each deck makes up for a portion of that, but during the early years, the drag is probably greater than that makeup payment. Is that correct?
I think, yeah, let me answer that in a slightly different way. I think you're right in terms of the early payments are going mostly to interest and less to principal. So you're not, in the first early years of the amortization schedule, you're basically making up for the lost investment opportunity that your money would have earned you. And, it takes a little while going forward to replace that principal.
And
So-
you're not quite probably making up for it, where the interest costs, the opportunity costs are still outpacing the makeup payments.
I think it also depends on what's happening in the market too, so some of this happened early on when the Depression or the Great Recession was hitting also. So paying it at an assumed rate was probably higher than what we would have gotten in the market had that money been there. So there's a lot of nuance around
Right, yeah.
going back 20+ years to sort of ask a lot of what ifs, there's so much nuance and so much complexity that the picture can get complicated really quickly. But I think what you're saying is right, that early on, most of your payment is going toward basically making up for what you would have earned in the market under current assumptions in place, rather than replacing the money that should be invested in earning that money. But over time, yes, that's why the unfunded liability is typically projected to go up a little before it goes down when all else is equal, is you need your payments to catch up. You can make up for your principal.
Thank you.
Other questions? Excellent. Well, since we have Chris in the hot seat and since we've only been at this for about 20 minutes, let's go ahead and jump over the break and we'll take the break after this next discussion. And the next discussion is around the VSERS system and the actuarial analysis that we requested about cross subsidization between groups. So
Sure.
as I'm looking at the packet of documents, I see a one pager that
Yes.
has member data by group. I see Chris Roop's overview of VSERS pension cross subsidization, and then I see a Siegel report, legislative request number 1, allocation of liabilities and costs between groups. So which document would you like
Sure.
us to start with?
So I'd like us to start with the PowerPoint that says overview of VSERS pension cross subsidization. What I basically did is I tried to take the actuarial analysis we got and turn it into something a little more plain English that we can walk through. But some of the detail that's in the slide deck can also be referenced in the actuarial analysis, because that's where all my numbers came directly from. But this way we can work on something that's maybe just a little bit more user-friendly. This chart, and I apologize, I got to you late. This was hot off the presses right as I was walking over, was I thought you all might just appreciate some context around what these different employee groups look like in terms of their size and their membership. So this all comes directly from the FY20 actuarial valuation, which is online. But that way you can see that, the benefits and just the memberships are inherently different between these groups. So I'm going to start with this PowerPoint. And let's just talk a little bit about what we mean by cross.
Would you, as you're going through here, remind everybody of who's in group A, C,
Sure.
D, and F?
Sure.
Just
Group,
so, because I think that a lot of people don't.
sure.
Bay has 1 member.
So-
we can probably just-
Yes.
So I don't think we need to worry too much about Group A. Group C is law enforcement and public safety. Group D is the judicial. And Group F is sort of the general state employees that everybody that doesn't fit in Group C and Group D is hired into Group F.
Thank you.
And that's the vast majority of the workforce. So let's start on the second slide of the slide deck. Let's just talk about what is cross subsidization. Every single one of us has a different career trajectory. You don't necessarily know in the future exactly what any one person's benefits are going to cost, because you can't necessarily know what their salary history is going to be, how long are they going to work, how long are they going to live in retirement, and what's their exit and entry age. So there's a lot of sort of assuming happening based on what a cohort's retirement benefit is likely to cost. And in addition, each one of these groups' benefits has a different cost and a different price tag because the terms of the benefit are different. So some groups earn a different benefit multiplier. Group C earns 2.5% multiplier, Group F earns 1.67. There's different demographic projections for each group. There's different salary histories for each group. So long story short, there's a whole lot of variation we need to account for when we're making our budgeting assumptions. It's impossible to know exactly what these costs are going to be in the future on an individual basis. So we make reasonable assumptions. And a big reason why we need to make these reasonable assumptions is we need to figure out how to budget for these costs in some way that makes sense. So we use a blended rate. And the blended rate basically means that the employee, and I'm talking about the employer share of the cost right now. So every agency, every fund that's employing a member pays the same rate, regardless of whether that member is enrolled in Group C, Group D, or Group F. Blended rates lead to lots of budgeting efficiency for obvious reasons. You can apply the same rate to the same payroll, but it does inherently lead to cross-subsidization just because, you're applying one rate that accounts for all this variation at a little bit more granular level. So, and as I said here on the bottom of the slide, if you're a department that employs Group C, you're paying the same pension charge as a department that paid Group F. So let's take a look at the normal cost. So as we've heard, the total normal cost represents the present value of the cost of the benefits that were earned by the active workforce each year. The employee contributions active members pay go toward the normal cost, and the employer pays the rest of that normal cost that employee contributions are insufficient to fully cover through the ADAC. So the theory is whenever they calculate this normal cost rate, it's a percentage of pay. If you just consistently pay that percentage over the course of an employee's career, there should be enough money left over at the end to fully fund their retirement benefits. That's sort of the theory that happens there. And the normal cost can really be a useful proxy, which we heard from Nazra during the last meeting, to represent the relative cost of different retirement benefits. So if you've got a benefit package that's more generous or more expensive, and all else is equal, you're going to have a higher total normal cost associated with that benefit. It is important to note, though, that when you look at smaller cohorts of employees, like anything else, the data can be skewed kind of in weird ways. So if you have groups that have unusual entry and exit patterns with the workforce, so if you've got a group, I'll use Group D as an example, because that's what the actuaries pointed out in their analysis. They have a much later entry age than Group F does. So that changes the calculation of what the normal cost will be. So generally, the normal cost rate will be higher if your entry and exit ages are later than if your entry and exit ages were sooner. That is a hard, it's very complicated about how the actuaries actually calculate the normal cost. But if you have a group where people are coming in at age 50, for example, and only working for 15 years on average, you need to spread that retirement benefit cost out over 4 years. And they're happening later, so your opportunities to gain through investments are shorter when you're putting money in when somebody's at age 50 as opposed to when they're at age 30. So you see that skew some of the numbers, especially on Group D. The VSERS normal cost and the unfunded liability payment are both included in that blended retirement charge that all of the employing agencies and funds pay. And right now that for budgeting purposes is 19.5% of payroll for FY22. So all employees and agencies pay that rate regardless of who exactly in their workforce belongs to which group. But since the total normal cost varies quite a bit by employee group, using that blended rate obviously leads to some degree of cross-subsidization. Slide 4 shows you what the total normal cost in terms of dollar expense translates to across all employee groups. So across all groups, the total VSERS normal cost is $73.2 million, or roughly 12.67% of covered pay. Employees, on average across all groups, pay 6.79% of their pay in contributions. So that funds $39.2 million of the normal cost. And the remainder, 5.88% of pay across all groups is paid by the employer. But you can see on this chart that the vast majority of the normal cost is really attributed to Group F, because that's where the majority of the active workforce, it belongs to. Slide 5 shows you what the normal costs look like across all the groups. So the blended employer normal cost across all groups, as we just said, is 5.88% of pay. And that, and the total is 12.67% of pay. You can see that on the bar on the far right side where it's total. That bar, that data reflects the whole system-wide data across all VSERS groups. But you can also see that there's significant variation between the normal costs of Group C and D and Group F. But keep in mind the relative size of these groups. If the normal cost was not cross-subsidized, agencies and funds employing Group F members would pay about 1.03% less than they're currently paying through the blended rate. And I got that number by taking a look at the Group F combined and the difference between that and the total. But the employing agencies and funds that hire Group C members would pay 10.3% more than they're currently paying through the blended rate. And as I noted, the Group D normal costs are particularly high, but keep in mind that there's a small number of entering and exiting members, and they enter at a later age, so that does skew those numbers a little bit. Are there any questions on that slide?
I have a question. I have one of those ones that's probably a very obvious question, but I'm just going to ask it for the record, Molly Stoner. While the employer costs are blended, the employees are not, right?
Correct.
Okay, thank you.
All right. Slide 6 just compares, take a look at the total normal cost for each of these groups. And then what percentage of that total normal cost is covered by employee contributions. So across all groups, employees pay about 53.6% of the total normal cost. Employee contributions across all groups fund a little more than half of the cost of future retirement benefits that the workforce is earning. Group F members pay the highest share of the total normal cost of their group's benefits. They pay, 57.8, it says here. But Group F's total normal cost is the lowest of all groups, as you saw on the previous slide. Group C and D members pay the lowest share of their total normal costs of their group's specific benefits, and their total normal costs are the highest of all groups. Any questions on that slide? Sir.
And maybe I missed this. Can you just clarify, what is the Group F asterisk? Can you explain?
The employees hired after July 1st, 2008.
2008. Are they paying a higher rate?
They're paying the same rate.
Same rate.
There's slight differences in retirement eligibility. So F asterisk has the rule of 87. Old Group F did not have the rule of 87. All right. Move on to slide 7. This is a very short slide deck. So we took a look at the total normal cost piece of the equation. Let's take a look at the unfunded liability side of the equation. So just like with the normal costs, the unfunded liability varies by group. And it's also paid through the employer through a blended rate that reflects the amortization payment across all the groups. If there was no cross-subsidization of either employer cost, and the recommended state contribution was instead developed on a group-by-group basis, the agencies employing Group F members would pay about 2.5% less than they're currently paying through the blended rate. And agencies and funds employing Group C members would pay over 26% more than the blended rate. Is there any question? Sir.
How raises the question to me is how Group D is paid. What does that come out of the general fund, or does the judiciary pay for that?
The employing agencies of
Yeah.
Group D members pay the blended rate. So don't have the big bill in front of me right now, but I would venture most of that comes out of the general fund. So everybody's paying the blended rate right now.
Peter Fagan might know the answer to that.
Peter Fagan, the House Judiciary is paid general fund money. It is almost entirely general fund money. There's a little bit of other funds that do go in there, mostly fees, things like that. But the vast majority of it is general fund.
And that is an interesting question because who pays the salaries of different groups varies as well. So I would imagine without having the encyclopedic knowledge that Representative Fagan has of the big bill, Group C members, for example, are probably largely funded through the general fund, the transportation fund, and some other special funds. And Group F members have much more federal funding involved. So the funding sources vary by by where somebody works and what types of jobs they do.
Chris, I don't know if this is clear or not, but I think I have this right, that the group D is not judiciary employees, it's just judges.
Correct.
It
That's
is-
my understanding. Yeah.
Yeah, it isn't all judiciary employees. They fall into group F, most of.
And there's also on the other sheet that I passed out, just for some relative context, Group D's got 52 active members,
52.
52 as of the end of FY20, whereas Group F has 8,000. Okay.
One more question, Chris. So on this slide, is there a number for Group D, would pay X% more than the blended rate?
Yeah, I mean, we would just have to subtract 49.4 from 19.81.
I couldn't hear Eric's question.
Sure, so the slide lists agencies and funds employing Group F would pay X% less, employing Group C would pay X% more. My question was just how that worked out for Group D.
Yeah, it's 30.03% if my math is right. But I've only had one cup of coffee, so somebody should check that. All right. Sir,
I just want to make, this is Dan Trout. I just want to make sure I'm understanding what you're saying correctly. Group D has a much smaller number of people. So when this blended rate of whatever, let's just say it's 5%. Obviously, 5% of 50 people is much less than 5% of 8,000 people. Is that accurate?
it's based on the size of the payroll,
Okay.
not based on the number of members in and of
Gotcha.
itself.
Okay. Okay. So obviously with 50 people, that payroll is much less than a payroll of.
Well, on a per member basis, they have a much higher average payroll than the other groups.
Sure. Okay. But when you say it's cross subsidized, it's not, if I'm understanding correctly, it's not cross subsidized by the employees putting in, it's subsidized by the department that is paying that particular portion of their
Yes.
rate.
Yes, I think you honed in on really the heart of the matter. There's the employer, like the employing agencies and funds is where the cross subsidizing
Okay.
occurs between the groups.
Gotcha.
That's sort of issue one. Issue two is, the amount employees pay in terms of the percentage of the cost of their retirement benefits varies quite a bit across groups as well. So
Gotcha.
those are really the two
Gotcha.
major issues here.
Gotcha. Okay.
So slide 8 takes a look at let's ask the question, what would happen if there was no cross subsidization happening? What if we completely reversed the way we've been doing things and did things on a more group specific basis? So the total blended pension costs. So this includes what the employees pay plus what the employer pays. It's 26.61% of pay across all these service groups. And these charts here show you what those numbers look like. The only real difference between this chart and the previous one is I added a layer at the top of the columns that shows you what the employee contribution rates are. So that way you see what the total picture is of money going in from all sources across all groups. But if we held employee contributions constant and the employers stopped using that blended rate and instead charge different rates specific to each group, the total required pension contributions for Group C would be 54.42% of pay. For Group D, it would be 56.49% of pay, much higher than the 23.93% of pay for Group F. The next slide, slide 9, looks at this question from another angle. What if we didn't hold employee contributions constant? Instead, what if we held the employer contribution constant at 19.81%, which is at current blended rate, and the employer just puts that 19.81% into each group's specific sort of bucket, if you will, rather than into the big picture? You would see that Group F employee contributions would actually decrease a little bit from 6.65 to 4.12 because the employer contribution for Group F actually increased a little bit. So the employer contribution would cover a little bit more of the normal cost than it currently is. But if you take a look at Group C and Group D contributions, they would increase to more than a third of salary. So slide 10 tries to summarize all this and put a bow on it. You know, the VSER system uses a blended employer contribution rate, regardless of which group their active members belong to. And this is efficient for budgeting and actuarial purposes. When you disaggregate the data, the normal cost and the unfunded liabilities do vary pretty significantly from group to group. Group F employees pay for a greater share of the cost of their benefit than Group C and Group D, and they have the lowest total cost of benefits versus other groups. Group C and Group D have relatively larger normal costs and shares of the unfunded liability, but they represent very small shares of the active payroll. So using that blended rate leads to employer cross-subsidization of these costs between groups. The agencies that employ Group F subsidize the employer pension costs of the agencies that employ Group C and Group D. But just keep in mind the relative size of these groups really does matter a lot. That cost to Group F members from this cross-subsidization practice is relatively small, but the gain to Group C and Group D employers is very significant. You know, if you're a department that's employing Group C and Group D, paying 19.8% is obviously much easier than paying the much higher rate that would be required if they had to pay a very specific rate for that's group specific to their payroll. So if the employer costs were held constant at the current 19.8% blended rate, and these contributions were credited to each group's specific normal costs and unfunded liability at that 19.8% rate, you would see a small reduction in Group F contributions from 6.65 to 4.12 because the employer's payment would be higher than what that group's costs currently are. But Group C and Group D employees would see their required employee contributions increase to over a third of their covered salary and wages to fully fund their group's respective obligations, because that 19.8% employer share would be much lower than what the true cost of those groups' pension benefits and unfunded liabilities are. That's a mouthful. I'm going to shut up now, answer any questions you may have.
Again, questions or restatements of what you think you heard to confirm understanding? Molly?
Molly Stoner. I had a question about Group D. We were talking about how they start later in their careers usually. Is there any data that shows how many of members of Group D were in Group F previously and how they may have pensions related to that as well?
I do not have that data. The treasurer's office or the actuaries might, but it is probably not a very large cohort because we're dealing with a pretty small universe of employees.
Okay, thanks.
Andrew Emmerich, are you gonna, I have some questions on this document. What is the annual allowance mean?
That's how much total benefits are paying for the service for the group directly above it. So if you look at directly under service pensioners, those 103 people are currently collecting a pension benefit that totals $2.7 million in cost for FY20. And while you're looking at this, this also kind of illustrates why the Group C and D normal costs are significantly higher than Group F. One reason is, the average payroll is quite a bit different. The benefit structure is different, and the employment patterns are different. It's not uncommon for public safety pension benefits to have a higher normal cost than non-public safety pension benefits. I mean, you see that in major systems all across the country.
And so just if we were trying to figure out just what the average benefit would be, then we would just take that annual allowance and those service pensioners and
Yeah, that data actually exists directly in the FY20 valuation. It's towards the end. All of this data came from there. I think the average benefit is around $21,000 across all groups, if I'm doing that from memory, but double check that.
Okay.
And it's a similar number for the VSTR, the teacher system as well.
So the Seagull slide deck is the nitty gritty details. We're welcome members to go through at their leisure.
Sure. Yeah, the Siegel slide deck, this is the analysis they provided us. You know, what we asked the actuary to do is take a look at the 2009 analysis and essentially update it. And the most relevant and interesting slides, I think, are really page 5 through 7. Those are the most relevant to our analysis.
Great. Any questions from task force members? All right, we are ahead of schedule.